In the vast world of finance, currencies are always on the move. They rise and fall against each other constantly. This dance of values is what Forex trading is all about. But to trade, you need to understand the very basic unit, the currency pair. Think of it like a seesaw. On one side you have one country's currency. On the other side, you have another country's currency. Their relative value is what we are interested in. You are essentially betting on which currency will get stronger or weaker compared to the other. It's a fascinating interplay of global economics. A currency pair quite simply shows you the value of one currency against another. For example, EUR/USD tells you how many US dollars you need to buy 1 euro. You are never just buying euros in isolation in the Forex market. You are always buying one currency and simultaneously selling another. This is a fundamental concept. It's like swapping one type of collectible for another. The rate at which you swap them is the exchange rate represented by the currency pair. This two-sided nature is what makes Forex unique and dynamic. Imagine you are planning a trip from Europe to the United States. You will need to exchange your euros for US dollars. The rate you get is determined by the EUR/USD currency pair. If the rate is 1.10, it means 1 euro will get you 1.10 US dollars. This rate isn't static, it changes all the time. These changes are driven by a multitude of factors, reflecting the economic health and prospects of the respective countries or regions. Understanding this relationship is the first step to navigating the Forex market effectively. So every time you see a currency pair, remember it represents a direct comparison. It's a financial tug-of-war between two economies. One currency is pitched against the other. The price of the pair indicates how much of the second currency, the quote currency, is needed to purchase 1 unit of the first currency, the base currency. This simple structure forms the foundation for all Forex trading decisions. It's the language of the global currency market, a language you need to learn to speak fluently if you wish to participate. When you look at a currency pair like GBP/USD, it's presented in a specific way. The first currency listed, GBP in this case, is called the base currency. The second currency listed, USD, is called the quote currency, or sometimes the counter currency. This is a universal convention in the Forex market. The base currency is always the reference. It's the currency that has a value of 1 unit in the quotation. Think of the base currency as the item you are looking to buy or sell. The quote currency is what you use to make that transaction. The exchange rate itself tells you how much of the quote currency is needed to buy 1 unit of the base currency. For example, if GBP/USD is quoted at 1.2500, it means that 1 British pound, the base currency, is equal to 1.2500 US dollars, the quote currency. So to buy 1 British pound, you would need to pay $1.25. If you were selling 1 British pound, you would receive $1.25. It's a straightforward concept once you identify which currency is the base and which is the quote. This understanding is crucial for placing trades correctly. Consider an analogy. Imagine you are at a fruit market. You see a sign that says, 1 apple = $2. Here, the apple is like the base currency. It's the item you are interested in. The $2 is the price, just like the quote currency. It tells you how much of the second thing, dollars, you need to get 1 unit of the first thing, the apple. In Forex, the apple is 1 unit of the base currency, and the price is expressed in units of the quote currency. This simple comparison helps to demystify the structure of currency pair quotations. Understanding the base and quote currency is vital for interpreting price movements. If the EUR/USD pair moves from 1.1000 to 1.1100, it means the euro, the base currency, has strengthened relative to the US dollar, the quote currency. Now 1 euro buys more US dollars. Conversely, if it moves from 1.1000 to 1.0900, the euro has weakened. You need fewer US dollars to buy 1 euro, or rather, 1 euro is worth fewer US dollars. Grasping this dynamic is fundamental to making informed trading decisions and managing your risk. In the vast ocean of currency pairs, some are more prominent than others. These are known as the major currency pairs. Think of them as the superstars of the Forex world. They are the most traded pairs globally. What makes them major? Typically, they always involve the US dollar, USD, on one side of the pair. The USD is the world's primary reserve currency and is involved in the vast majority of global trade and finance. Its dominance makes any pair involving it highly significant and liquid. The other currencies commonly found in major pairs are from large, stable, and highly developed economies. These include the euro, EUR, the Japanese yen, JPY, the British pound, GBP, the Swiss franc, CHF, the Canadian dollar, CAD, and the Australian dollar, AUD. So, pairs like EUR USD, USD JPY, GBP USD, USD CHF, AUD USD, and USD CAD are all considered major pairs. These pairs account for the bulk of daily trading volume in the Forex market. This high volume means they usually have tighter spreads, which is the difference between the buying and selling price. Why are these pairs so popular? Their popularity stems from the sheer size and global interconnectedness of the economies they represent. The United States, Eurozone, Japan, and the United Kingdom have enormous economic output and international trade flows. This leads to a constant need to exchange their currencies. High liquidity is a key characteristic. This means you can usually buy or sell these pairs easily without causing significant price fluctuations. For traders, this translates to more predictable price action and lower transaction costs compared to less traded pairs. Trading major pairs is often the starting point for many new Forex traders. The abundance of readily available information, news, and analysis on these economies makes it easier to form trading biases. Economic data releases from these countries are closely watched by the entire market, often leading to significant and tradable price movements. While no trading is without risk, major pairs generally offer a more stable and accessible entry into the Forex market due to their inherent characteristics of high liquidity and lower volatility compared to other pair categories. Once you move past the major currency pairs, you encounter what are known as minor currency pairs. These are also sometimes referred to as cross-currency pairs, or simply crosses. The defining characteristic of a minor pair is that it does not involve the US dollar. Instead, these pairs consist of two of the other major currencies being traded against each other. For example, EUR GBP, Euro versus British Pound, EUR JPY, Euro versus Japanese Yen, or GBP AUD, British Pound versus Australian Dollar, are all minor pairs. They offer trading opportunities without direct exposure to USD movements. Minor pairs are still quite liquid, though generally less so than the major pairs. The economies they represent are significant, such as the Eurozone, the United Kingdom, Japan, and Australia. Therefore, there's still substantial trading volume in these pairs. However, because they don't involve the USD directly, their pricing can sometimes be derived from their respective USD pairs. For instance, the EUR GBP rate is influenced by the movements of EUR USD and GBP USD. This interconnectedness can sometimes lead to more complex price dynamics than the major pairs. Trading minor pairs can be attractive for several reasons. Some traders might have a specific view on the relative strength of two non-USD economies. For example, if you believe the Eurozone economy will outperform the UK economy, you might trade EUR GBP. These pairs also offer diversification opportunities. If a trader wants to avoid exposure to specific US economic news or events, trading crosses can be a viable strategy. Spreads on minor pairs are typically wider than on majors, reflecting their slightly lower liquidity, but they are still manageable for most traders. It's important to understand that while they are called minor, these pairs are still very significant in the global Forex market. They involve currencies from some of the world's largest economies. The term minor is purely relative to the major USD-centric pairs. For traders looking to expand their horizons beyond the most common pairs, minors offer a good balance of liquidity and unique trading opportunities. They require a good understanding of the economic factors driving the two constituent currencies, independent of direct US influence. Section 5. The Wild Frontier, a look at exotic currency pairs. Beyond the major and minor currency pairs lies a category known as exotic pairs. These pairs are like the adventurous explorers of the currency world. An exotic pair typically consists of one major currency, often the US dollar or euro, paired with the currency of a smaller or emerging economy. Examples include USD/TRY, which is the US dollar versus the Turkish lira, UR/ZAR, which is the euro versus the South African rand, or USD/MXN, which is the US dollar versus the Mexican peso. These pairs represent economies that might be less stable or have smaller global trade footprints compared to major economies. Trading exotic pairs comes with a different set of characteristics compared to majors or minors. Firstly, liquidity is often much lower. This means there are fewer buyers and sellers at any given time. As a result, The spread, which is the difference between the buying and selling price, can be significantly wider. This makes the cost of trading exotic pairs higher. You need a larger price move in your favor just to cover the spread and break even. This is a critical consideration for anyone venturing into these markets. Furthermore, exotic pairs can be much more volatile. Prices can swing dramatically in short periods. This increased volatility can be due to various factors, including political instability, sudden changes in economic policy, or a high dependence on commodity prices in the emerging markets economy. While this volatility can present opportunities for substantial profits, it also carries a significantly higher risk of substantial losses. Managing risk effectively is paramount when dealing with the unpredictable nature of many exotic currencies. Despite the higher risks and costs, some traders are drawn to exotic pairs. They might offer opportunities not found in more conventional pairs, especially if a trader has specialized knowledge of a particular emerging market. Sometimes, interest rate differentials between the two currencies can be very large, making carry trade strategies, borrowing in a low interest rate currency to invest in a high interest rate currency, potentially attractive, though this also carries risks. Exotic pairs are generally recommended for experienced traders who understand the unique risks and have robust risk management strategies in place. Section 6. The movers and shakers, factors influencing currency prices. Currency prices are not static. They are in a constant state of flux. Numerous factors contribute to these movements, reflecting the perceived health and attractiveness of one economy versus another. One of the primary drivers is economic data releases. Key indicators such as gross domestic product growth, inflation rates like the Consumer Price Index, employment figures like non-farm payrolls in the United States, retail sales and manufacturing output all provide insights into an economy's strength. Strong positive data often leads to currency appreciation, while weak data can cause depreciation. Political stability and geopolitical events also play a crucial role. Countries with stable political environments and predictable governance tend to attract more investment, which can bolster their currency. Conversely, political turmoil, elections with uncertain outcomes, trade disputes, or international conflicts can create uncertainty and lead to currency weakness. For instance, a surprise election result or escalating trade tensions between major economic blocs can send shockwaves through currency markets, causing rapid and significant price adjustments. Traders must stay aware of the global political landscape. Market sentiment and risk appetite are also powerful influencers. During times of global economic optimism, investors may be more willing to take on risk and invest in currencies offering higher yields, even if they are from emerging markets. This is often called a risk-on environment. However, during periods of fear or uncertainty, investors tend to seek safe haven currencies such as the US dollar, Swiss franc, or Japanese yen. This risk-off sentiment can cause these safe haven currencies to strengthen, even if their domestic economic data isn't particularly strong. Market psychology is a potent force. Finally, the flow of capital between countries significantly impacts exchange rates. Foreign direct investment, portfolio investments like buying stocks and bonds, and international trade balances all contribute to currency demand and supply. A country attracting significant foreign investment will likely see its currency appreciate due to increased demand. Similarly, a country with a large trade surplus, exporting more than it imports, will also experience upward pressure on its currency. These flows are like tides, constantly shifting the balance of supply and demand for different currencies. Section 7. Central banks, the conductors of the currency orchestra. Central banks are arguably the most influential players in the currency markets. Think of them as the grand conductors of their respective economies' monetary orchestras. Their decisions and pronouncements can cause significant and immediate movements in currency pairs. The primary tool central banks use to influence their currency and economy is monetary policy, which most notably includes setting benchmark interest rates. When a central bank raises interest rates, it generally makes holding that country's currency more attractive to foreign investors seeking higher returns on their capital, thus potentially strengthening the currency. Conversely, when a central bank lowers interest rates, it can make holding the currency less attractive, potentially leading to depreciation. Central bankers don't just make decisions, they also communicate their future intentions through statements, press conferences, and meeting minutes. This forward guidance is closely scrutinized by traders, Hints about future rate hikes or cuts or changes in the bank's assessment of economic conditions can be just as powerful as actual policy changes. The market often tries to anticipate these moves, leading to price action even before an official announcement. Beyond interest rates, central banks can also engage in other operations that impact currency values. Quantitative easing is one such tool, where a central bank injects liquidity into the money supply by purchasing assets like government bonds. Quantitative easing typically aims to lower longer-term interest rates and stimulate economic activity, but it can also lead to currency weakness by increasing the currency's supply. On the other hand, quantitative tightening is the reverse process, where a central bank reduces its balance sheet, which can support a currency. Sometimes, central banks might intervene directly in the Forex market by buying or selling their own currency to influence its value. This is less common for major central banks like the US Federal Reserve or the European Central Bank, but it can occur, especially if a currency is perceived to be moving too rapidly or to undesirable levels. Such interventions can cause sharp, albeit often temporary, price swings. Understanding the mandates, tools, and likely reactions of key central banks is absolutely critical for any serious Forex trader. Section 8. Fan favorites. Popular currency pairs and their appeal. Certain currency pairs are consistently popular among traders and for good reasons. The EUR-USD, Euro versus US dollar, is often dubbed the king of Forex pairs. It is by far the most traded pair in the world. This immense popularity stems from the fact that it represents the two largest economic blocs, the Eurozone and the United States. The sheer volume of trade and investment flows between these two giants ensures constant activity and very high liquidity. This translates to very tight spreads, making it cost-effective to trade. Abundant news and analysis are also readily available for both economies. Another highly popular pair is the USD-JPY US dollar versus Japanese yen. This pair is significant due to Japan's status as a major global economy and the yen's role as a safe haven currency. During times of global market stress, investors often flock to the yen, causing the USD-JPY to fall as the yen strengthens. The Bank of Japan's monetary policy, which has often been very accommodative, also plays a huge role in driving this pair. Its liquidity is excellent, and it's closely watched by traders around the clock, particularly during Asian trading hours. The GBP-USD, British pound versus US dollar, often referred to as cable, is another stalwart in the Forex market. Its name harks back to the 19th century when the exchange rate was transmitted via a transatlantic telegraph cable. The UK's economy, its historical ties with the US, and London's role as a major global financial center contribute to this pair's high trading volume. It can be quite volatile, offering significant trading opportunities but also requiring careful risk management. Economic data from the UK and Bank of England policy are key drivers for cable. Other popular pairs include AUD-USD, Australian dollar versus US dollar, often influenced by commodity prices as Australia is a major commodity exporter, and USD-CAD, US dollar versus Canadian dollar, nicknamed the loonie, which is also sensitive to oil prices due to Canada's large energy sector. The popularity of these pairs comes from their good liquidity, the availability of information, and the clear economic drivers that traders can follow. They represent a good starting point for understanding how global economic forces translate into currency movements. Section 9. Conclusion: Why understanding currency pairs is your trading compass. Grasping the intricacies of currency pairs is not just helpful, it's absolutely fundamental to successful Forex trading. Each pair tells a story of two economies in relation. It reflects their relative strengths, weaknesses, and future prospects. Without a solid understanding of what a pair represents, how it's quoted, and what influences its price, a trader is essentially navigating a vast ocean without a compass or a map. Knowing the difference between major, minor, and exotic pairs helps you choose instruments that align with your risk tolerance and trading strategy. Understanding currency pairs allows you to interpret market movements more effectively. When you see EUR-USD rising, you know it means the euro is strengthening against the US dollar, or the dollar is weakening against the euro, or a combination of both. This basic comprehension is the first step. Delving deeper, you can then analyze why this is happening. Perhaps due to a European Central Bank statement, strong Eurozone economic data, or weak US employment figures. This analytical process is at the heart of informed trading decisions. Furthermore, knowledge of currency pair characteristics helps in risk management. Major pairs with their high liquidity and lower spreads might be more suitable for beginners or strategies that rely on small price movements. Exotic pairs with their higher volatility and wider spreads demand more experience and robust risk controls. Choosing the right pair for your trading style and capital is a crucial risk management decision in itself. It's about matching the instrument to your capabilities and market outlook. In essence, currency pairs are the building blocks of the entire Forex market. They are the instruments through which you express your views on global economic trends and events. Taking the time to learn about their characteristics, the factors that drive them, and the roles of influential bodies like central banks equips you with the essential knowledge to participate more confidently and strategically in the world's largest financial market. Your understanding of currency pairs is your most reliable guide in the dynamic and often challenging journey of Forex trading.